The markets are sending mixed signals. Some indexes are soaring while others are lagging behind, but there's a century-old strategy that might explain it all. Dow Theory could be the key to understanding today's chaos, and in this video, we're unpacking what it means for your money. Hey everyone, I'm Robert, and welcome back to The Alternative Investor. Today, we're diving into a powerful concept called Dow Theory. This isn't just stock market history, it's a living framework that's still sending signals, especially now as markets are in flux. And you'll want to pay close attention, because those signals might be warning us about what's coming next. Dow Theory is widely recognized as the foundation of modern technical analysis. It was developed from the ideas of Charles Dow, the co-founder of the Wall Street Journal and the original editor of the Dow Jones Averages. At its core, Dow Theory proposes that the market moves in trends, and that these trends can be analyzed and confirmed through patterns in price and volume, specifically across two major indices, the Dow Jones Industrial Average and the Dow Jones Transportation Average. According to the theory, a market trend is only considered valid if both of these indices are moving in the same direction. This intermarket confirmation is essential to understanding whether a rally or a decline is truly sustainable. The market discounts everything. Dow Theory starts with the idea that all available information, whether economic data, earnings reports, or even investor sentiment, is already reflected in the price of a stock. That means technical analysis can be used to read the market without needing to interpret every piece of news. Markets move in three types of trends. The market moves in a series of trends. The primary trend is long-term, lasting months or even years. Secondary trends are shorter corrections or rallies within the primary trend, typically lasting a few weeks to a few months. Finally, minor trends are short-term movements that last only days or weeks. According to Dow Theory, a trend unfolds in three phases: accumulation, public participation, and distribution. In the accumulation phase, informed investors begin buying or selling quietly. During public participation, momentum builds and the broader market joins in. Finally, the distribution phase is when early investors begin to exit and pass stocks off to latecomers, often right before a reversal. A critical rule in Dow Theory is that the Dow Jones Industrial Average and the Dow Jones Transportation Average must both move in the same direction to confirm a trend. If one index hits a new high but the other doesn't follow, that's considered a bearish divergence and a potential sign of weakness. Price moves alone aren't enough. Volume must increase in the direction of the primary trend. So if prices are rising but volume is declining, that's a red flag. A healthy trend is usually supported by strong trading activity. Finally, Dow Theory assumes that a trend remains intact until there's a definitive signal that it has reversed. Investors are advised not to try and guess tops or bottoms but to wait for confirmation before acting. At the moment, we're seeing a potential divergence between the major indices. The Dow Jones Industrial Average has recently broken out to new highs, suggesting a bullish outlook. However, the Dow Jones Transportation Average has not followed suit and has instead been underperforming. This discrepancy raises concerns for those who follow Dow Theory. If transportation stocks, especially shipping, freight, and airlines, aren't confirming the industrial rally, then the rally might not be as strong as it seems. In essence, if goods aren't moving, how sustainable is industrial growth? Another layer of caution comes from the volume data. While stock prices have climbed recently, the trading volume behind those moves hasn't been particularly strong. This is troubling from a Dow Theory perspective because it implies that the current uptrend might lack conviction. When volume doesn't rise with prices, it often suggests that institutional investors are staying on the sidelines and that the rally could be driven by short-term traders rather than long-term believers. So, what's the takeaway here? Dow Theory isn't about predicting the future, but it is about recognizing the warning signs that appear before major market moves. When the two Dow indices diverge and volume weakens, it's a signal that something might be wrong under the surface. This doesn't necessarily mean you should panic or sell everything, but it does mean you should review your portfolio, assess your risk exposure, and prepare for potential volatility. Smart investors use these signals not to time the market, but to make better informed decisions. Dow theory might be old school, but it's still incredibly relevant, especially in uncertain times like these. The divergences we're seeing right now could be an early warning that markets are due for a shakeup. If this video helped you think differently about the current market environment, make sure to like, subscribe, and turn on notifications so you don't miss our next deep dive. I'm Robert, and this is The Alternative Investor, where smart money stays ahead of the curve.